Let's talk about something so many of us in the UK rely on: generous cash gifts from family. You know, helping out with a first home, or just lending a hand. But what seems like a simple act of kindness can sometimes, believe it or not, trigger a really complex and stressful investigation from HMRC. To help you navigate all this, the experts at ProTax Accountant have put this guide together. So let's dive right in.
First up, just look at this number. £38.5 billion. I mean, wow. That's the absolutely staggering amount the Bank of Mum and Dad has given out in the UK in just the last 4 years. It's a huge figure, right? It shows that this kind of family support isn't just a nice little bonus anymore. It's a fundamental part of our economy. But with all that generosity comes a really critical question.
And this is the absolute crux of the issue. From HMRC's point of view, a big chunk of money suddenly appearing in your bank account isn't just a gift. It's a red flag. They need to know where it came from. Is it a genuine, no-strings-attached present, or is it income you haven't declared? You can see how getting this wrong can lead to a very stressful and potentially very expensive investigation.
For first-time buyers especially, relying on family for a bit of financial help has gone from being, helpful to being pretty much essential. That dream of owning your own home, for many, it's powered by this generosity, which makes it a cornerstone of the modern property market. But this new reality brings with it a whole new set of rules we all need to get our heads around.
This chart, looking at the 2025-26 tax year, just shows you the reality in black and white. The average deposit for a first-time buyer who's getting help is a massive £118,000. For those trying to do it all on their own, it's $86,000. That gap is precisely why family gifts are so common, and it's also why they are firmly on HMRC's radar.
To make all this a bit more real, let's follow an example. Let's meet Sarah. She's a freelance designer living in London, and her parents have just gifted her £50,000 for a deposit on her first flat. Now, she's over the moon, of course, but she's also a little bit nervous. What are the rules? What does she and her parents need to think about to stay on the right side of HMRC? We'll keep coming back to Sarah as we break down the rules.
Okay, so let's get into the specifics. While giving and receiving gifts feels like a personal thing, once the amounts get big enough, they fall under a really clear set of regulations. Understanding these rules is the absolute first step to making sure a generous act doesn't accidentally become a tax nightmare.
The first key number you really need to remember is £3,000. This is what's known as the annual exemption. Basically, every single person in the UK can gift up to $3,000 each tax year without any inheritance tax issues at all. It's totally clean. So, for Sarah, both her mom and her dad could each gift her £3,000 for a total of £6,000, completely tax-free under this allowance.
And here's a brilliant little pro tip for you. If one of Sarah's parents didn't use their £3,000 allowance from the previous tax year, they can carry it forward for 1 year. This means they could potentially gift her up to £6,000 in one go. You combine that with the other parent's allowance for this year, and you're already up to £9,000. It's a simple but really effective bit of planning.
So, what about the rest of Sarah's £50,000 gift? Well, the amount that's left over, above those annual exemptions, falls into a category called a potentially exempt transfer, or a PET. Honestly, the easiest way to think about a PET is like a 7-year countdown clock. If the person who gave the gift, in this case Sarah's parents, lives for a full 7 years after making it, poof, the gift becomes completely exempt from inheritance tax. It's literally wiped off the slate.
But what if the person who gave the gift doesn't survive for the full 7 years? Well, that's where something called taper relief comes in. This chart shows perfectly how the potential tax bill actually shrinks over time. If the person passes away within the first 3 years, the gift gets taxed at the full 40% inheritance tax rate. But from year 4 onwards, the tax rate starts to taper down, reducing each year until it finally hits 0 after that 7-year mark.
Right. This leads us to the question that's probably on your mind. How on earth would HMRC even find out about a private cash gift? It's so easy to think, it's a private transaction. They'll never see it. But that is where most people go wrong. Nowadays, HMRC has more insight into our financial lives than ever before.
Okay, let's bust a huge myth right now. That idea of a completely random tax investigation, it's pretty much a thing of the past. Over 90% of HMRC's compliance checks are triggered because their systems have flagged something specific, some piece of data that suggests something isn't quite adding up.
So how do they get that information? Well, this slide shows it all.
They have an incredibly powerful computer system called Connect, and through mandatory reporting, HMRC gets a direct feed of data from banks, building societies, you name it. They see the interest you've earned and other income, and they use it to build a really detailed financial picture for every single taxpayer. And that picture is what they use to spot anything unusual.
So, what are the things that actually trigger an investigation? Well, first, a mismatch between your declared income and your lifestyle. If you say you earn £25,000 a year, but you're buying a £500,000 flat, that's a red flag. Unusually large transactions, like Sarah's £50,000 deposit suddenly landing in her account, will get noticed. Constantly filing your tax returns late also suggests something might be up. And finally, yes, they do act on tip-off.
So the system flags an issue, and then the thing you dread happens. A brown envelope from HMRC lands on your doormat announcing a compliance check into your tax affairs. This is the moment where panic can really set in, but it's also the exact moment where a calm, strategic response is absolutely critical. And hey, if you feel that way, you are definitely not alone. This quote from an official government research paper confirms it. People find the idea of an investigation daunting. Even if they know they've done nothing wrong, the worry about them uncovering accidental mistakes is very, very real. It's a universally stressful thing to go through.
So the most crucial thing is, don't panic. An investigation is a process. It's not a conviction. But your actions from this point on will have a massive impact on the final outcome. That's not all. Here's where a lot of people go wrong.
Now, listen, this slide is absolutely vital. There are two ways to give information to HMRC. Unprompted is when you realize there's a problem and you tell them before they find it. This shows you're cooperating and can lead to much, much lower penalties. Prompted is when they contact you first. At that point, you're on the defensive, and the penalties will be significantly higher because you didn't come forward on your own.
And don't ever think that time is on your side. For simple, careless mistakes, HMRC can look back up to 4 years. But for cases they think involve deliberate tax evasion, they have the power to investigate your finances going back a staggering 20 years. Stay with me. The next point might be the most important one of all.
Here it is. This is probably the most important pro tip of this entire discussion. Whether you're giving the money or receiving it, create a simple signed letter. It just needs to state the amount, the date, and, this is key, explicitly say that it is an outright gift with no expectation of repayment. For Sarah, this letter from her parents is her single most powerful piece of evidence to prove to HMRC and to her mortgage lender that the £50,000 was a gift, not a loan or undeclared income.
Look, if you're facing a complex situation, or worse, you've got that investigation letter, the single best step you can take is to get professional help and get it immediately. Trying to handle this all by yourself against HMRC's dedicated teams is a huge risk. A real expert can manage the whole process, make sure you're treated fairly, and work to get any potential penalties as low as possible.
So let's just quickly recap what we've covered. First, know about that £3,000 annual gift allowance and the 1-year carry-forward rule. Second, for any bigger gifts, that 7-year countdown clock is crucial. Third, always, and I mean always, document the gift with a signed letter. Fourth, if you spot a mistake, be proactive. Telling them is so much better than them finding out. And finally, at the very first sign of trouble, get professional advice.
Now, of course, it's really important for me to say that all this information is for general guidance. Tax law is incredibly complex, and everyone's situation is unique. So before you make any financial decision, it's absolutely essential that you consult with a qualified tax expert for advice that's tailored specifically to you.
And for that expert advice, whether it's on cash gifts, HMRC investigations, or any other tax issue, you can get in touch with the specialists at Pro Tax Accountant. You can reach them on WhatsApp or by phone at 0798 568 9912, or you can drop them an email. They really have the expertise to guide you through it. For more insights just like these, make sure you subscribe to their channel. Thanks so much for joining us.